Tom Lee, the dip hurts, but it will print millionaires by June of this year, June 2025.
Well, because Tom Lee, the Wall Street wizard behind Fundstrat, just dropped an explosive prediction you simply cannot afford to ignore. He boldly stated that the next 90 days will create the next generation of millionaires, and it's going to happen by the end of 2025. If you do what he's saying now, by the end of this year, you're going to be sitting very, very pretty. And in today's video, we're going to unpack exactly how and why he believes this incredible opportunity is unfolding right now. Now, if you've been following markets lately, things have indeed felt rocky, uncertain, downright scary. We've got tariffs, recession worries, inflation fears, you name it. The dogs are running around without leashes. The headlines have been nasty, but here's the kicker. While everyone else panics, Mr. Tom Lee sees golden opportunities hidden in the chaos. He's not asking, how do I avoid the market? He's asking, how can I make profits off the market? In fact, he argues what we're witnessing isn't a market crash, but rather a temporary growth scare, just a speed bump on the road to much, much, much higher gains. Now, as you know, Tom...
And listen, it totally could be. Totally could be. But now is not the time to be jumping in, right? Now, as the market's coming down, this is like jumping off a cliff, saying that it's like jumping off a cliff, thinking that the bottom of the cliff is just right here. The bottom of the cliff is right there, right? You ever done cliff diving? Maybe you went swimming, right, in college. Nobody that I knew ever did this for sure. I definitely don't know what I'm talking about. Maybe you went cliff diving in college and, the water's right there. No big deal. I'm going to bounce in and then I'll be able to climb the rocks right back out of it. Sounds like fun, right? But the problem is that we don't actually know how far that cliff is. So if you're buying right now, the cliff could be here. The cliff could be here. We don't know. And for those of you who say you can't time the market, all that kind of stuff, right? You don't have to time the market perfectly. Nobody says you have to. But you can read the market. You can read the market. You can let the market tell you which direction it's going. The 10, the 20, and the 50. I call this the Outlier Trend Template because it works. Why does it work? It's math. There are times when you might lose a buck or make a buck here and there, but it tells you where the trend is going. It is perfect math, undeniable math. You can't fight me on it because it's true. Now, the 10 period, that's your short-term moving average. The 20 period, that's an intermediate-term moving average. And the 50 period, that's your longer-term moving average. If they're all pointing down, that means price is lower than it was 10 days ago, 20 days ago, or 50 days ago. If they're all pointing up, that means price is higher than it was 10 days ago, 20 days ago, or 50 days ago. This is simple. It's free. You can add it on any chart, on any platform with like 3 clicks. And then you will know when the dip has stopped. In fact, let's go to COVID. Let's specifically go to COVID because everyone wants to compare this, saying that like, oh, just look at COVID. Right after that point, everything went straight back up, right? COVID was down 35% in the span of 22 days. 22 days. That is what extreme fear looks like. We're not even close to that. We are like dipping our toe into fear right now. This is extreme fear. When did the dip stop? Right here, but you didn't know that. You didn't know that. You could be like these YouTube gurus right now, which I don't want to count myself as that. I want to count myself as something else. Don't call me a guru. These YouTube gurus who are like, oh my gosh, right here, buy the dip. It will print millionaires by the end of the week. By next week, you will be a billionaire. Stuff like that, right? And like I said, you don't know how far that cliff is going. So you might get in and you might be super stoked when you get this first green candle, even though you're down 7% on the market, closes up at 4%. And then another green candle, you're like, oh, that was it. That's the bottom. Trust me. I am sure that there were people saying this was the bottom. I am very sure that there were plenty of people saying this was the bottom right here. And it was only getting started. And then the cliff decided, you know what? I think I'm going to do something else. I'm going to do something else. And it just went down and down and down and down 35% in 22 days. And you think the people up here, which we'll compare that in just a moment here, you think the people who bought it right here saying, oh, now's the best time to buy ever. You think they were feeling like geniuses down here? I don't think so. But if they had added the Outlier Trend Template to their charts, they'd have known that the dip ended. The dip actually ended this candle right here. This candle here was when the dip actually ended. The 10 was over the 20. Price finally crossed over the 50. So let's compare these 2 points. Let's make this one green. And the other one's red. This is where the other YouTube gurus were saying the dip is over. This is what they're doing right now. This is what they're doing today. This is where I would say the dip is over. And where did I get that from? The Outlier Trend Template, 10 over 20, price over the 50. Which one of those was a better buy? I mean, you might have lost a buck, made a buck over here, over there. But that was a much better buy. If you're going to buy the dip, let the dip tell you when it's over. Right? Let's say you held through here. Right? Best case scenario, let's say you held through here. You were already up 10% before these people were back to break even. Let that sink in. Let that sink in for a moment. By seeing where the Outlier Trend Template tells you when the dip is over, you were already up 10% before these fools were back to break even. Put a F in the chat if that makes sense to you. Put an F in the chat if that makes sense to you. Because you can see it right on the chart. The 10 is over the 20, price is over the 50. And like I say, you might have lost a couple bucks here and there trying to get the right entry. But these people are claiming now is the time to buy. And I'm telling you, let the market tell you when it's time to buy. There's so many Fs. Awesome. Awesome. I'm glad that this makes sense, right? Because anybody, yeah, Jay says, this is a F. Anybody who's out there trying to tell you now is the time to buy, they don't know where the bottom is. But you can tell where the bottom is. You can tell where the bottom is. Gary says, this makes so much sense. Mikey Mike says, this is so cool. Yeah. You're already up 10% before they're back to break even. Which would you rather do? Which would you rather do? F, yeah, that's right. Nate says, another YouTuber had a good term for financial YouTubers. He called them finfluencers. Fin for financial, yes. I would call myself a finfluencer. So when someone says buy the dip right now, just look at them and say, go watch the Outlier channel, and you'll see what a big difference it is to wait and hang out until the dip tells you it's over. Because, I mean, if we compare it side by side, we don't know how far that's going to go. Superfly says he hasn't seen how to get the new Nancy Pelosi special where you can see the right-hand side of the chart. Listen, it only costs $80 million a year, but when you have the Nancy Pelosi special, you can actually see the right-hand side of the chart. They don't let everybody see it. Only if you pay $80 million a year do you get that.
Isn't your average analyst. This is a guy who consistently nails market calls when everyone else gets it wrong. And that's why we talk about him so much on this channel. And just a quick refresher, I mean, you can go back to prediction after prediction after prediction that he got right and caused many people to make tons and tons of money as a result. Just back in 2023, amidst a sea of bears calling for...
So I've been on TV probably 100 times. And my publicist at the time, I was really nervous before the first time I was on TV. And she's like, listen, Chris, go on, give your opinion. And if you're right, no, everyone's going to forget about it. If you're wrong, everyone's going to forget about it. So it's like these people can come on TV, basically say whatever they want. And if they are right, then that can be their calling card. I predicted this thing. But if they're wrong, everyone forgets about it.
For doom, Lee went bullish. People said he was an idiot, that he was crazy, that he was going to be laughed off of Wall Street. And guess what? He was spot on, and anyone who listened made serious money. And he made his clients oodles and even poodles of dollars. And now he's back again, taking another bold...
By the way, Scrooge McDuck is my spirit animal. Like, legitimately, I am surrounded by Scrooge McDucks. There's one right here. I have one right here in his little Scrooge McDuck car. I have a Scrooge McDuck Lego. I have a Scrooge McDuck painting on the wall over there, a Scrooge McDuck painting on the wall over there, another Scrooge McDuck Funko Pop right here. I have, I went to Disney World last year. Oh, this is not going to come out well with the green, but there's these little, like, I forget what they're called, gondolas that take you around the different parks. There was a Scrooge McDuck one there, and I had to get my own little one of those. I love me some Scrooge McDuck.
contrarian stance. As people are out for blood, he's saying, wait a second, why are you looking for blood? Now is the opportunity of a lifetime. He explains that the next 90 days is going to matter a lot. And in today's video, we're going to dive into exactly why. But as always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence before taking any action on any ideas presented. And also, quick plug, today's video is brought to you by our 100% free daily email newsletter report. We deliver research on trade ideas, catalysts, and key happenings each and every single day, and we don't want you to miss these reports, so I'm going to put that as the first link right down below. Okay, so Lee says that we could see the market bottom right here, right now. Yes, literally this week could mark the lowest point of this downturn. Historically, March, April, and May have delivered explosive rallies even when market sentiment was at rock bottom. Why? Well, because markets typically hit bottom before the bad news peaks. By the time things feel their worst, smart investors are already buying and markets are setting up for a powerful rebound. Here's another angle Lee emphasizes: the Federal Reserve. While everyone is worried about higher rates and tighter monetary policy, Lee believes the Fed is about to pivot, perhaps sooner and more aggressively than anyone expects. If upcoming jobs and economic reports show weakness, and Lee anticipates they will, well, the Fed will likely accelerate interest rate cuts. This isn't speculation, it's a classical historical pattern. Lower rates mean higher stock prices, plain and simple. Now let's talk specifics, AI stocks. Lee acknowledges some recent skepticism around high flyers like Nvidia. Yes, the AI trade cooled off a bit after last year's massive run, but this isn't the end of the story. It's just an intermission. Lee argues that the long-term demand for AI, data analytics, and productivity enhancements hasn't changed. Companies like Nvidia, Microsoft, and Palantir, despite recent pullbacks, are positioned for another wave of massive growth as AI adoption accelerates. Speaking of Bitcoin, hold on to your hats. Tom Lee is doubling down on his ultra-bullish stance. He's now predicting Bitcoin could surpass $150,000 this year, driven by wider acceptance, institutional money pouring in, and decreasing macroeconomic headwinds. Even if Bitcoin feels volatile right now, well, look at the history. I mean, history shows it makes most of its annual gains in just 10 explosive days. Miss those 10 days and you're out of luck. That's why Lee strongly advises staying invested even through these.
This annoys me. This whole thought that if you're in on just those days, you're a billionaire. Like, well, first off, nobody knows when that day is going to happen. So their thesis is you can't be out of the market, because if you're out of the market, one of those days could be the biggest days. I want to see a couple things real quick during this COVID crash. I bet you one of these days was the biggest day of the year. Maybe this one right here. Yeah, the market was up 9% that day. 8.991% that day. Was that really the one day you wanted to be in the market? Let's see. The market was up 5.1% that day. Let's see. From the bottom to here, the market was up 8.6% that day. Give me a whole break. Give me a break with that, right? Yes, there are big moves that can happen on single days. You don't know when that's going to be. But if they're having those big moves in a downtrend, it doesn't matter. It doesn't matter at all.
These choppy patches, making sure to buy the dip. Because if you don't buy the dip, well, it's going to be hard to let it rip, right? But at the same time, Lee is real. He says, look, there's genuine risks. Lee openly acknowledges the geopolitical wildcard that are Trump's tariffs and the further tariff threats. If Trump pushes tariffs too far, inflation could surge while wages stagnating, triggering stagflation. And that is a recipe for disaster, a genuine recession risk. However, Lee says that he doesn't believe that Trump will take tariffs to the extreme, at least not over a long-term time horizon. He thinks it's a negotiating tactic, and he also thinks that the market has already partially discounted Trump's tariff threats as political posturing, and thus Lee sees this as more of a scare than a genuine threat. Here's the bottom line, folks. The most crucial part of Lee's message isn't about picking the right stocks or sectors. It's about investor psychology. Warren Buffett, the Buffett of Warren, famously said, be greedy when others are fearful. And that's precisely Lee's philosophy here.
Sorry, I have so much going on in my throat right now. Be fearful when others are greedy, and greedy when others are fearful. You know, I mentioned that too. And this is not the time to be greedy. This is not the time to be greedy. When people are fearful AF is not the time to be greedy. And why is that? That's because you're not going to be the guy who is the one guy right here. And he's like, buy? Well, everyone is screaming sell in his face. I think you found the bottom. No way. No way. As all this panic is happening, no way. Be fearful when others are greedy, and greedy when others are fearful. It's like when the market's going up like this, it's to say when they're worried, it's climbing the wall of worry and down the slope of hope. Like, I really hope that it comes back up. But if you're buying it all the way up here, That, my friends, is contrarian trading. That's what Mark Minervini described it as. And that's because so many people are looking at this and they're saying, oh, it's too far. I can't buy it. Oh, I'm worried it'll crash after this point. Oh, I can't buy it when it's this high. And then it continues to go higher and higher and higher. And then when they see these first sell-offs, they're like, oh, now's the time to buy it, right? Now's the time to buy. Now's the time to buy as it sold off some. Right. It's not as simple as you think of. Buy when it's low, sell when it's high. No, it's be fearful when others are getting greedy, and be greedy when others are getting fearful, in the opposite direction.
Kind of sounds cliche at this point, but look, when markets panic, investors bail, and fortunes are left on the table for the few, well, you got to be one of those few that is up and grabbing those fortunes. And in order to do that, you got to remain disciplined and strategic. And that is what Lee is saying right now. Tom Lee says, look at the facts. Focus on the facts. Bear markets historically average just 10 months, while bull markets average 5 years. So play the odds, stay disciplined, and the wealth building opportunities become undeniable. Now, Tom Lee has highlighted yet another critical factor that's often overlooked, and that's market breadth. Recently, as you know, we've
market breadth, something we talk about literally every day.
Seen markets propped up by a handful of major tech stocks, while many smaller companies have been underperforming. Lee points out that broader participation when more sectors join the rally is essential for a truly healthy bull market.
It is, and let's explain why, right? Imagine each one of these stocks, or each one of these people on here represents an individual stock. If each one of them represents an individual stock, and they're all pushing up higher, and they're all screaming buy, and they're all going up, that pushes the market itself up. Does that make sense? That's why market breadth is so important, because 40% of the stock move is due to the market. If the market's going up, that lifts all ships. 30% of a single stock's move is due to the sector. If the sector is moving up, that lifts all ships. And only the last 30% of a stock's move is due to the stock itself. So if you have 70% of your move caused by everybody else in the market, that's what you need to have pushing you up. And there are cases, we've seen several this week where some of your stocks in the chat have just outperformed like crazy. And if those stocks had a strong market and a strong sector with them, they'd be ripping even higher than you could imagine.
Right now, breadth is improving, indicating stronger foundations for a robust comeback. Watch for...
Actually, breadth is improving. Here in Outlier, let me scroll over. This is something I noticed this morning. We are starting to see more buy signals come through. Now, granted, market breadth is still weak, but we might have a bullish crossover here on market breadth here in a minute, which is very interesting. Very interesting.
For breadth improvements over the next few weeks, as this is often a precursor to explosive upward moves overall. Now, I know that Tom Lee is considered a permeable, but he's not just somebody that's throwing predictions out blindly. He's also watching some key indicators that tell the real story beneath the headline. One of those is the put/call ratio, a powerful gauge of market sentiment. Right now, it's flashing extreme bearishness. Historically, extreme bearish sentiment tends to precede market bottoms and significant rallies. Lee's advice, pay close attention to that, because when sentiment flips, gains can happen swiftly and violently. And speaking of opportunities, let's discuss small cap stocks. So Tom Lee has repeatedly emphasized that small cap stocks, specifically represented by indices like the Russell 2000, could lead the next rally. They've been beaten down back.
Let's look at IWM. IWM, that's the small cap index. Oh, bro. That smells worse than a dirty diaper right there. That is awful.
Badly creating historically attractive entry prices. Lee believes these smaller high-growth companies could be amongst the biggest winners in this rebound, providing outsized returns for investors willing to step in early. Another critical point Tom Lee stresses is seasonality. Yes, I know seasonality sounds boring, but stay with me here. Historically, the stock market tends to follow distinct seasonal patterns. Lee points out that we're entering one of the strongest seasonal windows for stocks. And over the past few decades, Q2 has consistently delivered impressive returns, especially following periods of market uncertainty like we're experiencing right now. So
I would not, just because it has historically done this, doesn't mean that this should be a trading indicator for you, right? Like the market itself right now, especially if we're looking at small caps right here, make sure you follow the price, right? I don't know how much more I can talk. Just be sure to follow the price. Because even an indicator like this showing that this second week of March is always a boom could be true. But I'm going to let the price dictate what happens.
The calendar itself might just be another tailwind in our favor. Now, folks, Tom Lee has been crystal clear about where he sees the greatest opportunity, though. Yeah, he sees opportunity almost everywhere, but there's one specific spot that he sees more opportunity than anywhere else, and that is in tech. Despite, yes, recent volatility, well, tech remains his top pick. He specifically calls out semiconductors, software services, and AI-driven businesses as sectors ripe for explosive millionaire-making growth. But I want to be clear, we're talking about companies with robust balance sheets, relentless innovation, and
oh, there's Mark, the smartest man I know. What they never mention is that the results are just as good if you skip the 10 worst days of the year. Yeah, good point, Mark.
dominant market positions like Nvidia, AMD, Palantir, and many other emerging disruptors. According to Lee, these sectors are positioned for significant gains once the market shifts sentiment from fear to optimism. And beyond tech, Lee is also bullish on cyclical stocks, industrials, financials, and materials, sectors that thrive in an environment of accelerating economic growth. With rate cuts on the horizon and inflation fears subsiding, these cyclical names could deliver powerful returns as investors rotate away from defensive sectors and bonds into growth-sensitive equities. And we love when growth stocks rally, don't we, folks? So he's saying, look, it's all about positioning ahead of the crowd to capture that initial explosive move. Now let's talk about what investors are missing.
No, don't position yourself ahead of the crowd, because if the crowd never shows up, you're going to be left with something like this. If the crowd never shows up, you're going to be left with something like this. If the crowd never shows up, you're going to be left with something like this. You want the crowd. Your one bank account is not going to be enough to push these higher. It's not going to happen.
To Lee, the current market anxiety is actually healthy. It shakes out weak hands and sets the stage for sustainable rallies. He emphasizes that it's precisely this kind of environment of fear and pessimism that creates maximum opportunity. Market sentiment indicators he tracks closely have rarely been this bearish, which historically sets the stage for significant reversals. Another fascinating piece of Tom Lee's thesis involves liquidity conditions. Despite headlines about tightening monetary policy, liquidity isn't drying up as fast as people think. Central banks worldwide, including our Fed, remain committed to ensuring stability. Lee notes that when markets realize liquidity is still robust enough to support economic growth, we'll likely see a flood of investment returning to equities. Moreover, Tom Lee's message includes cautionary wisdom about the perils of market timing. He emphasizes repeatedly, timing the market perfectly is virtually impossible. Instead, he recommends an approach of disciplined incremental investments, ensuring you're positioned to catch the big moves when they happen. Dollar cost averaging into strong names that you believe in during periods of uncertainty has consistently proven effective, especially
dollar cost averaging is such a fallacy, right? Let's say that you went 30 years buying a certain target date fund to retire, right? You're so stoked, you're ready to retire, but yet during the meantime, you've been adding to it the entire way, and you had no idea because you were blindly buying it every 2 weeks on your paycheck that it was on its way down. And then you get to retirement and you're like, wait a minute, wait, what happened? How, I can't retire now, but I did the right thing. I did what I was supposed to do. It only works if the price of your asset is going up. If the price of your asset isn't going up, dollar cost averaging into anything is a terrible idea. It's a terrible idea because, as you know, only price pays. And only price is going to pay at the end of the day, no matter how many shares you have, if it's going up. So dollar cost averaging your shares down, well, it sounds great. Oh, I can buy this company at a cheaper price. Do you really want to be buying this company right now at that cheaper price? Who knows where it's going to go up? Do you really want to be buying this company now? Oh. Do you really want to be buying this company now? Averaging down your average price? I certainly wouldn't.
During
okay, that's pretty funny. That's pretty funny.
Volatile periods like right now. Lastly, consider Lee's personal record. Back in 2020, he made a similar bold prediction that few believed in at the time. He called for a massive rally post-pandemic when nearly everybody else out there was panicking. And guess what? He was dead right. Investors who listened to him then saw enormous returns. With a similar setup unfolding today, ignoring his current prediction could be a costly mistake. So here's the action plan he lays out unfolding today, ignoring.
We're right here. We're on like this very first candle, okay? If we crash, I'm not saying we're going to crash, but if we crash, we'd be right here at this very first candle. I hate when people pull up examples like this and they're like, see, if you bought the dip, you'd be making so much money now. Right? How long did it take before that came back, by the way? That was like 2 years before that came back. Or maybe it wasn't in 2020. But yeah, there's points where if you buy the dip, it'll be years before it comes back.
His current prediction could be a costly mistake.
Yeah, Nico, exactly. Buy the right-hand side of the V. Right. Buy the right-hand side. You know when it stops. Oh, Chris says, great call on the entry point on HIMS. I added an alert and it's already printing. You are welcome. You can pay me back, Chris, by just telling everybody about it. You're welcome, my friend.
Stake. So here's the action plan he lays out for investors looking to ride this wave. You got to stay calm. Do not let your panic dictate your investment decisions. Emotional investing almost always results in losses. You got to identify quality stocks at discounts. Look at proven winners and disruptive.
Okay, Sandro. How can I buy stocks on the way up if it's always going down after I buy? It just feels like that sometimes, dude. I understand.
Sectors. AI technology giants like Nvidia and Palantir, electric vehicles like Tesla, and fintech. You got a dollar cost average. Consistently and gradually buy into your highest conviction stocks. Even better if they're discounted massively. Timing the market perfectly is nearly impossible, but consistently investing through dips significantly boosts long-term returns. You got to trust historical patterns. Lee has shown again and again and again that when markets price in too much bad news, explosive rallies typically follow, and history doesn't lie. And finally, you got to consider this incredible statistic that Lee shared. The top 10 market days each year often deliver up to 20% of the annual gains. Missing those days because of fear or attempting to time the market perfectly can dramatically hurt your long-term returns. Now, here on this channel, we're a big believer in trading the market, right? Buying in at good prices, riding it up, and locking in some profits. And he's not saying that's bad here, but what he's saying here is that if you're just going and panic selling all of your long-term positions every single time there's a little bit of bad news in the economy, well, you're going to miss out on some of the best performing days out there. And that's just a historical fact. Over the last century, investors who missed the top 10 days each year would have seen their returns plunge from positive territory into significant losses. Just let that sink in. You missed just the top 10 days each year and your return.
It's just like beating this point home. I completely disagree with this. Because A, we don't know when that day is. So in their theory, it's just hold always, because that way you'll never miss that day. To Mark's point earlier, what about the 10 worst days? All right, I don't see them talking about the 10 worst days on here.
Returns plunge from positive territory to significant losses. And this is data dating back 100 years. So here's the final takeaway from Tom Lee. The next 90 days could indeed make millionaires, but only for those who stay the course, embrace uncertainty, and invest strategically. Tom Lee's track record speaks for itself, and right now he's giving us a once-in-a-generation playbook. It won't be easy, it never is, but the potential rewards are staggering. If you're ready to grab this opportunity, make sure you're subscribed, smash that.
Oh, I hate when people say this is a once-in-a-generation opportunity to buy. You have to buy it now on the way down. Otherwise, you're such an idiot, and it's only going to go up from here. But listen, let me introduce myself. My name is Christopher Yu. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. And let's look at today's, let's go ahead and rank today's video. You put it in the chat. I'm not necessarily ranking Zip Trader himself, but I think we're rating Tom Lee here. I think we're rating Tom Lee here in a nutshell, honestly. I think that's what we're doing here. So we're rating Tom Lee's ultra bullish sentiment. Let me get the slide. Which slide has more of ours on there? I think it's this one. Oh, no. This is the more recent one. Okay. Yeah. So we're really ranking Tom Lee saying buy everything at this point. 3, 3, 5, 3, 3, 3.5, 5, 7. Dadgummit. I knew somebody was going to do it.
Kalani. Nobody gets a 7, my friend. Or Canwall Sanini. Nobody gets a 7. Nobody.
5, 4, 5. I'm not a fan of Zip Trader, but he always mentioned the risky, and I appreciate that too. Too much FOMO pushing. Yeah, very, very pumpery type of video. I agree. So let me grab a screen cap of this right here. And I think we're looking around a 4 or 5. I think we're looking for a 4 or 5. I'm going to go with the 4 as well. I like that one. All right. We'll go with the 4 right there. I'll do a 4.5. That kind of hits in between there. That'll work. Philip says, if we're voting on buy everything now, yeah, for sure. Tom doesn't have a window pane jacket like you do. I trust a man who wears a window pane jacket. Well, thanks. Actually, I wanted to start looking just this much nicer. There's a YouTube channel that I watch. His name is Myron Golden. I really vibe with him. And this is his go-to. And I was like, you know what? I could do that. That's easy. I got tons of blazers. I got tons of clean shirts. So why don't I just put the two together? So don't forget, you can save 64% on the annual pass over outlier.com. And if you're already in a monthly trial, just shoot us an email if you want to upgrade and we can take care of the rest. Now, let me ask you a question. What do you think? What do you think? We got a poll for today. And I want you to go vote over on my YouTube channel. I want you to go vote over on my YouTube channel what you think. Learn to take losses. Well, this is really good with today's video here. Learn to take losses. The most important thing in making money is not let your losses get out of hand. What do you think? Now, first one is you never lose if you don't sell, which I actually get a lot of comments like that. You don't lose if you don't sell, my friend. Paper gains or paper losses don't mean anything until I actually sell. Okay. Or real traders manage risk. I want you to go vote. I want you to go vote on that right now over on my YouTube channel, and we will look at the results in just a little bit. But in the meantime, let's put your stocks in the chat. Let's take a look at a few of them. Let's take a look at a few of them here. Let me close a couple tabs. Leisure GQ. Yeah, Leisure GQ. I think I'm recognizing a brother in Christ. Yeah, that's me, my friend, for sure. By the way, Outlier blocks will be coming soon. Very excited about that. Interesting. 10, 20, 50, all pointing south, right in the middle of this order block right here. We'll see if it bounces. We'll see if it bounces. But this is not a hold that I would put on for sure. Daniel wants to look at Colgate-Palmolive. Ooh, look at Colgate-Palmolive. Coming in hot. Let me remove some of my old notes here. All right, so you got your 10, 20, 50, right? This is such a great example, Daniel. Thank you. Why wait or why buy it on its way down when you can wait until, where's that crossover happen? Right there. Rather than saying, oh, this is the bottom, let me get in. You can wait from January until first real close over that point. Let's call it right here. February 27th. You could wait basically 2 entire months and then buy it at the same price. When this person is at break even, you're just getting started. And look at that run. But of course, it does have this order block right here. Just be really careful with that. If it crosses up into that order block, Daniel, that could be some significant overhead resistance, and it might be time to close that trade. But CL looks really sharp. Just might have some overhead. It's coming into that order block right now. So for me personally, here's what I would do. Here's what I would do, Daniel. Since it's crossing up into that order block, let's work through this the whole way. Let's work through this the whole way. So this is the bottom of the order block right here, 94.15. Let's draw it on the chart so we can see it when it gets lower time frame. All right, cool. It's coming up in there. Daniel, this is really good for you, my friend. Check this out. If it goes up into that order block, which it's doing right now, I would switch to the 5-minute chart. And on that 5-minute chart right here, you can see there's additional order blocks. I don't worry so much about those. If the 10 and 20 period on the 5-minute chart never cross, you could hold that the entire day and then close at the end of the day. That's what I would do. However, if the 10 and 20 do cross back, consider that a bearish signal within this uptrend. And that would be your exit point. But that's up to you. That's up to you. That's exactly how I would trade that today, my friend. So if you could have it up on your phone, maybe on a second monitor, maybe set an alert for a 10 and 20 cross. If they don't, go for it. Let's go take a look at that poll real quick. Let's see what you voted. The poll was, learn to take losses. The most important thing in making money is not letting your losses get out of control. Either you never lose if you don't sell, bro, or real traders manage risk. You know which one I'm going to pick. Real traders manage risk. 8% of you said you never sell or you never lose if you don't sell. What's wrong with you? Real traders manage risk. Or you might have just done that as a troll. I get that. I would also troll people doing that too. So be sure to tell me in the chat what you're trading and come back this afternoon where outliers like us will save time, make money, and start winning with less risk together as a team. And of course, YouTube is going to pop up a couple recommended videos. I recommend you watch one of them. And I also recommend you have a fantastic day. And I'll see you this afternoon in this afternoon's live stream.